Good afternoon, everyone, or good morning, actually. Hope you're all doing well. You're all feeling well. I just wanted to mention at this point that I did get official notice that next semester, the spring semester is going to be online. I'm not sure if that has been communicated to you yet, but unfortunately, that is going to be the situation. There, especially in light, if you're, of course, reading the news and keeping up with events, you see that numbers, the statistics for the coronavirus are in fact increasing. So that is going to be the situation. It does stink, I know, but that's what I've been told so far. So I'm not sure if you've registered already for courses, but just keep that in mind as you go forward. I'm sure a lot of schools are going to be operating under the same methodology as well. So, but that doesn't mean, give up. That doesn't mean, yes, it absolutely stinks, Jeffrey, you're right. But keep in mind, you have to work on yourself. You still have to build your skills, because when this is finally over, there's going to be opportunities out there. Okay, so don't, this doesn't mean you'll put everything on the back burner. You're going to have nothing else to do but study. Okay, if we go into lockdown again. So just keep building yourself up, okay? Keep building your skills, building your knowledge. Very, very important. These are going to be new times, okay, when this all finally breaks. Okay, so try to look at it in a positive perspective, okay, rather than just a negative. I don't think any of you are seniors yet, or very few of you are seniors, so hopefully you will have that live experience again, maybe in the fall or the summer if you decide to go. Okay. All right, so I have now posted all of your quiz grades and your midterm grades on Blackboard. If any of you have any questions or issues, just email me or text me. Oh, Christine, you still don't have yours? Okay, do me a favor, text me later, okay, or email me, and I'll. I saw that you took it. That's just something that's outstanding. And anybody else who has that situation, please just let me know individually, and I'll take care of it. You still can't see the exam? I thought, all right, I'll try that. Francisco, send me an email and I'll try to adjust that. That's just a setting on McGraw-Hill, so that should be okay. All right. Okay, so just in terms of our investment of Apple stock, again, basically the stock market, Wall Street had been anticipating that there wasn't going to be a stimulus package that is offered by the president. So we saw stock prices decreasing. Over the last day or two, there was a dip in the price of, in the market price of many stocks. Today now, Steve Mnuchin is basically indicating that they are working on some type of stimulus package, similar to what some of you may have received last time, either unemployment or one-time stimulus payments. So again, we saw the stock prices move up a little bit. So as of this morning, our share of Apple stock was trading at about $117.44. It was trading at about $119.83 last time we met, which last Thursday. Okay, and then Joshua, good question. Is the overall grade out of 100 or 110? So what the situation is that on Blackboard, I have to make it, theoretically, I have to put that if I add your midterm grade and your quiz grade, it has to be out of 110. Okay, but I will be grading it out of 100. So anything above 100, 100 or above, of course, would be an A+. So yes. Okay. All right, and there were some of those. Okay, you're welcome. The grades were good. Okay, and keep up the good work. All right. And for those of you who are not happy with your grade, again, there's going to be another midterm. Okay, towards like the third week of November, there's going to be another quiz, and then we're going to have a final as well. Okay, so just keep that in mind. All right. So this chapter, we were dealing with Appendix C, and we were dealing with partnerships. Okay, a very different type of business form. Okay, remember that when we are talking about partnerships, there are 3 different types of partnerships. okay, that you are basically responsible for. Three different types of partnerships. Anybody remember what they are? The names of some of the partnerships are? Okay, the first one, remember, is a general partnership. Okay, and remember, you're also excellent, limited, very good, Christian. A general partnership, a limited partnership, and a limited liability partnership. That's perfect. That's exactly right. Okay, so make sure that you know the differences between them as we went over. Also, remember the advice I gave you: don't ever enter into a partnership, particularly a general partnership, because of the fact of the liability and the exposure, the mutual agency and the unlimited liability. Okay, that makes it it could end up being a very expensive type of business form. Okay, and remember that even if you decide against my better judgment, but my better indications to you, if you do decide to enter a partnership, remember that you must have a partnership agreement, okay, which stipulates what everybody's roles and responsibilities are, and also how basically the proceeds of the partnership are going to be distributed. Hopefully net income, unfortunately net losses in the future. Okay, and what everybody's duties are. So at a minimum, okay, make sure you have a partnership agreement. Okay, so today now we are going to spend some time going over the record keeping, okay, for a partnership. All right, so here, and again, we went over this last time, but just as a refresher, okay, when a partnership is when two or more individuals basically come together in order to basically join and provide and do work for one entity. Okay, so here on this day, Joan Blair and Richard Cross, they had competing retail stores. They were sole proprietorships before. Okay, they decided to consolidate their assets, okay, and also their talents, okay, and come together and form a partnership. All right, remember, okay, each at the time that the partnership is formed, any assets that are contributed by the partners must be recorded, okay, on the general journal, the general ledger, okay, on the books of the partnership. Okay, so on this day, which is January 1st, we see here that Joan Blair contributed cash, accounts receivable, and inventory. What we see here, these amounts, okay, the 40,000 or the 60,000 and the 90,000, remember that this is the fair market value of these assets on this day. Okay, they had sole proprietorships previously, but on this day, they when they contributed the assets to the partnership, they were recorded at the fair market value. Okay, remember that any accounts payable that are contributed to the partnership basically are going to reduce the amount of the respective partner's capital account. Okay, so that $30,000 in accounts payable reduces that partner's capital account. So the total capital account for Blair on this day is $160,000. Okay, remember, in accounting, never forget your journal entries, how they're prepared. The debits first, the credits, then a little brief explanation afterwards. Okay, then here when Richard Cross contributed assets, he contributed $10,000 in cash, $60,000 in inventory, $60,000 in land, $100,000 in building. Okay, remember that this is the fair market value of these assets, okay, on this day, and that also both partners agreed that this is going to be the value that is going to be recorded on the books of the partnership. All right, and then he also contributed $70,000 worth of accounts payable, which reduced the amount of his capital account, which also equaled $160,000 on this day. Okay, so this is opening day for this partnership. Remember, okay, so let's say here Richard Cross contributed land with a fair market value of $60,000 on this date. Let's say a year down the road, they decide to dissolve this partnership. Remember, Cross could not say, okay, well, I contributed the land, I'm taking back the land. Okay, once an asset is contributed to a partnership, it now belongs to all the partners equally. Okay, it no longer belongs just to Richard Cross. So he cannot just say, okay, I'm taking back the asset that I contributed. It has to be done equitably. All right. Okay, so let's go on. What else happens in a partnership? Okay, so remember, when partners, if they decide to contribute additional funds or assets to the partnership, all right, whatever that asset is, and again, this is on the partnership's books and records. Okay, so here the partner contributed, the partners contributed $20,000 in cash total. Okay, so cash gets debited for $20,000, and then each of the respective capital accounts are going to be credited for the amount of that additional investment. So when there are additional investments, the capital accounts of the partners get credited directly. Okay, and that's what we see going on here. Okay, now, okay, what happens? And here I'll use this previous slide. If the partners decide, okay, to withdraw money from the partnership, okay, withdrawals are different. Okay, so let's say later on down the road, Blair decides to take $5,000 out of the partnership, to withdraw $5,000 cash from the partnership. Okay, that is called a draw. Okay, when a partner removes cash from a partnership, that is called a draw of cash or a drawdown of cash. When partners draw down on cash, the journal entry is different. Okay, what's basically going to happen is that Joan Blair, okay, rather than directly crediting her capital account, what's going to happen is Joan Blair is now going to, the partnership is going to prepare a drawing account, okay, for Joan Blair for the $5,000 or whatever amount she decides to withdraw from the partnership, $5,000, and then which account is going to be credited here? The cash account for the $5,000. Okay, so that's what the journal entry when partners withdraw cash is going to be recorded as. Okay, it's not a direct decrease to the capital account. Okay, and why is this done? Basically because if a partner withdraws cash, you want to make sure that it's tracked. Okay, it's tracked carefully, so that's why you would establish this drawing account. Okay, remember that the drawing account in a partnership is a temporary account. Okay, remember going back to Accounting 101? Okay, going back to Accounting 101, you remember that there are certain accounts on the income statement and also affecting retained earnings that must be closed at the end of the year. Okay, who remembers some of those accounts? What are the temporary accounts? Go back in your memory banks. Okay, which accounts? Very good, Lysander. The expense accounts have to be closed at year end. If the expense accounts are closed, you know that, excellent, Casey, the income summary account has to be closed as well. And remember, that's like that clearinghouse account. The revenue accounts, very good, Francisco. Those also have to be closed. And now, remember, if it's a corporation, okay, who else remembers? This is a good review. Excellent, Kristen. The dividend account. If this is a corporation, the dividend account also has to be closed. Again, that doesn't come up with partnerships. Let's just do a complete review. Okay, and now we have another account. Okay, in place of the dividends, if a partner withdraws cash, you are going to have to close the drawing accounts as well. Okay, so just keep that in mind. Remember also that journal entries are always really the backbone of accounting. If you're ever in an exam, in a quiz, or going ahead with your studies, for those of you who are going to continue to study accounting, if you're ever in doubt, the first question is, okay, whose books and records am I recording this information on? Okay, and the second thing is, okay, go back to the journal entry to see if you could try to determine, okay, what exactly was going on, how I record this transaction. Okay. All right. So now, all right, so what happens at year end? Okay, a partnership is different from a corporation. Okay, remember that when you have a partnership, okay, in the partnership form of business, all income must be allocated to the respective partners at year end. Okay, and also keep in mind, here we're talking about calendar year end. Remember, a partnership can also have a fiscal year. It's whichever end of year or fiscal year the partnership decides to report on. Okay, so again, a partnership is not a separate legal entity. A partnership is not going to basically declare any net income. Okay, or they're not going to file a tax return related on the amount of the net income. The partnership is just going to basically file an information return with the IRS, and then all income must be allocated. Okay, so here's the assumption here. Assume the partnership earned net income of $60,000 in the first year of operations. Also assume that for withdrawals, and remember, withdrawals are normal. They happen during the normal course of the business of a partnership. However, if you decide to enter into a partnership, remember, you're always going to want to limit, okay, the amount of withdrawals that any of the partners are able to make. Okay, exactly. That's it, Mark. Excellent question. There's never any retained earnings. Very good. In the partnership equity accounts, that's like that last, instead of a stockholder equity, it's partnership equity. And all you're going to have there is each of the individual partners, based on how many partners there are, you will have their individual equity accounts. Excellent. There's never a retained earnings account. Okay, because the partnership can't retain any earnings. That's exactly right. Okay, so here Blair withdrew $24,000 in cash, and Cross withdrew $16,000 in cash. So and the corporation had $60,000 worth of net income. All right, so the first thing we're going to do here, when we know there's net income, that means, remember, the income summary account has a credit balance. If there's net income, if it was a net loss for this year, the income summary would have had a debit balance. But since it has a credit balance, meaning that the revenues were greater than the expenses, okay, the income summary had a credit balance. So therefore, when the income summary account is being closed here, okay, remember that was Casey mentioned that was a temporary account. Here you're closing the balance in the income summary of $60,000. And then what happens? The capital accounts are going to be credited based on the amount of the allocation that was stipulated in the partnership agreement. Okay, remember that if there is no partnership agreement, okay, or if there's no written documentation of how all of the partners decided they were going to distribute or allocate net income or loss at the end of the year, if there's no documentation, the courts will decide that all partners are going to share in any net income or loss evenly. Okay. So, and here they did have a partnership agreement, and it was 50-50 because there were two partners. All right. Again, if there were four partners, it would be 25%. So all the four partners, okay, it would have to be evenly if there was no partnership agreement. Okay, so now what happens after this? Okay, now the drawing accounts have to be closed. Remember, the drawing accounts always have debit balances, okay, because they're going to be reducing the amount of the capital accounts. So when those temporary accounts, when the drawing accounts are closed at year end, remember they had debit balances, so when they're closed, they are going to be credited. Which accounts then are going to be debited, okay, at year end? The partner's capital accounts directly. Okay, remember, for withdrawals, they're not going to directly affect the capital accounts. They're always going to be reported separately first on drawing accounts. Okay, just so that it's easier to track them over the course of the years. Yes, and Joshua, yes, there's in the partnership contract, that's the place where you have to indicate how to allocate income. If there's no agreement, the courts will say it's going to be even among all the partners. I didn't see your question earlier. Yes, very good. Okay. And those are the journal entries, basically always the same for a partnership at year end. All right, so here now let's look at the income statement. Here again, this is for a partnership. Same income statement. Remember, income statement from Accounting 101. It always starts with the revenues or the revenues or the sales. Then after that, you have the cost of goods sold, and then finally you have the operating expenses being deducted to determine your net income, and then it's just a division of the net income. Remember, the net income always must be fully allocated in a partnership. Okay, you cannot retain any earnings in the partnership. Okay. All right, so let's keep going. All right, so remember, Mark, you mentioned retained earnings here. Remember that whenever we were doing at year end, okay, what a corporation would have to basically, after the adjusted trial balance, which financial statements are going to be prepared. Remember, it was the balance sheet, the income statement, and the statement of retained earnings. Okay, so here, when you have a partnership, rather than having a statement of retained earnings, what you're going to have is a statement of partnership equity. Okay, statement of partnership equity. Again, just like retained earnings, you start with what the opening balances were. Okay, each of them, remember, contributed $160,000. Then you add to that any additional investments, and then you add for any of the respective partners, you add the amount of net income for that year. Okay. You come up with a subtotal for this year for the capital accounts. Then you're going to subtract the drawing. Okay, and what does this tell you then? Okay, it tells you at the end of the year what each of the partners' equity accounts are, and also what the total partnership equity is. Okay, and again, you need that in order to prepare the balance sheet. All right, so again, pretty straightforward. Again, always give the detail, maintain each partnership account separately. Okay, now I have a technical question for you. Okay, now we see here that the amount of the additional investments, the amount of draw by the individual partners, but we also see the amount of net income allocated. Okay, so now if we look at Blair, okay, we see that she was allocated $30,000 of net income, but she also added an additional $10,000, and she also withdrew an additional $24,000. Which amount, okay, for Blair, which of those above amounts do you think she's going to have to claim as income, okay, on her personal tax return? What is the amount that Blair is going to show? Okay, so you say 40,000, okay, Joshua, all right, and you're saying that it's the net income plus the additional investments, okay. Anyone else have any guesses? 24,000, and okay, that's the amount that they withdrew. A lot of people think that their personal tax returns, 10,000, 20,000. Keep going. Oh, Christian, you got it. Ding, 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 ding. Sorry, didn't see Christian. Yes. It doesn't matter, okay? No, not zero. Remember, Jeffrey, that the amount of net income that is allocated to the individual partners, the amount of net income is the amount that it must be included on their tax return. So the $30,000, again, it doesn't matter, okay, that they contribute an additional $10,000, and it doesn't even matter if they withdrew $24,000. Okay, the amount of net income that was basically allocated to them, the $30,000, that is the amount that has to be included on their individual tax returns. Okay, it's only the net income allocation. Same thing for Cross. Okay, and okay, Cross contributed an additional $10,000. And he withdrew $16,000. Again, that basically affects their partnership capital accounts. The amount, though, that must be included as net income is going to be the $30,000. Okay, so very important point. All right. Very good, Christian. Good guesses. Okay, but just remember that point, very important. A couple of points on the next midterm. Okay, so now what happens again at the end of the year? We know that all the temporary accounts have to be closed, and we also know that net income must be allocated to the partners. Okay, so hopefully, when you're setting up a partnership, if you still decide to set up a partnership, you are going to make certain provisions, okay, as to how each of the partners are going to be allocated that net income. All right, so the first one is based on personal services. If 4 partners come together, okay, you decide on this, whatever this business plan is, okay, if 2 of you are going to work more in the partnership, the other 2 are just going to basically be contributing money or capital to the partnership and really not providing services. Okay, it could be that for the partners who work in the business, they want to get a separate allocation of net income because of the fact that they contribute services to the partnership. Okay, again, this must be spelled out in the agreement. All right, so personal services, okay, that could be provided for in the partnership agreement. Okay, if you have several partners entering into this partnership and each of them are contributing different amounts of capital, okay, again, that's not unusual. What the partnership agreement can stipulate is that basically the partners are going to be reimbursed, okay, or be paid interest based on the amount of capital that they have invested in the partnership. Okay, that's another alternative. Okay, and then finally the last is once you've made an allocation for the personal services, you've made an allocation for interest based on the amount invested in those in the partnership, then you can decide how the residual amounts, okay, how the residual profits then are going to be distributed to the partners. Okay, so if that is your intent, make sure that it is spelled out in the agreement. Okay, so, and again, you want to do it before you get into the agreement, not after. Okay, it's hard to negotiate after the fact. Okay, so again, recognizing each of these 3 factors is a good way to come up with a plan, okay, about how you're going to divide partnership assets. Okay, and these three different ways to compensate partners must be provided for in when the net income is allocated, and we'll see how in a moment. Okay, again, if one partner devotes their full-time employment, they could have worked for somebody else and gotten a salary. Okay, that whichever partners do that, they may insist, okay, I want a salary. Okay, again, it's not unusual that when a partnership is formed, one partner has special skills that they're contributing to the partnership. Okay, maybe they want to be rewarded for those skills that they're providing for the partnership. Okay, again, maybe some partners are contributing more funding, more cash. Again, this should be provided for in the agreements. Okay, and again, it should be written. It's not in your heads. Okay. All right, so we're going to go over now basically how this information, how each of those allocations are provided for, okay, in the books and records of the partnership. Okay, so we're going to start with simple and we're going to get more complicated. Again, this is probably going to surprise you because it's different than what you may have anticipated. Okay, so now we have these two partners. Again, it could be whatever number of partners decide to go get involved in the business. Adams and Barnes have formed a partnership and they agreed that they're going to divide income and loss first by providing a salary of $12,000 to Adams and $60,000 to Barnes. Okay, remember a very important point. Okay, salaries paid to partners. Salaries that are paid to the partners cannot be deducted. Cannot be deducted on the income statement. Okay, so if a partner is reimbursed for services that they are providing, that cannot be deducted on the income statement as an expense. Okay, instead, if a partner is going to be paid a salary, any partnership salaries, I'm sorry, any partner salaries, let me change that. Any partner salaries are considered an allocation of net income. Very, very important differentiation. Any partner salaries are considered an allocation of income. So always set up your worksheet for a partnership this way. Okay, so these two partners have decided that they're each going to be paid a salary. Any remainder after the salary allocation has been made is going to be divided equally. Okay, so here, net income to be divided. Again, this is year end, and now they're getting the net income. The net income for this year equals $96,000. All right, so the first thing that happens here, the first thing that must be deducted is the salary allowance. Okay, they've agreed to a salary allowance of a total of $72,000. $12,000 is going to be allocated to Adams. $60,000 is allocated to Barnes. Okay, so now since that income has been allocated, we can subtract the $72,000 from the total net income of $96,000. What is the remainder? $24,000. Okay, what did they decide? How did they decide up front that this is going to be divided? It's going to be divided evenly. Okay, so $12,000 is going to be, you take the $24,000, which is the remaining difference, and you're allocated evenly 12%, I'm sorry, 12,000 to Adams, 12,000 to Barnes. Okay, now all the income has been allocated. Okay, there's no net income remaining. So what does this mean? That means that Adams' capital account is going to increase by $24,000 at the end of this year because of the allocation, and Barnes's capital account is going to increase by $72,000. Okay, all income has to be allocated. Again, remember, right, if there was no partnership agreement, okay, how would these, or if there was no written partnership agreement and they went to court and they were arguing how income was going to be distributed, again, the courts would have just decided, take the net income of $96,000 divided by 2, and each of them would have been allocated $48,000. Okay, so here we saw that the intent was different. So here, since it was stipulated in the agreement, this is how the income was allocated. All right. So again, this net income to be divided, remember, we got that from the income summary account, right? That was the balance in the income summary account, a credit balance. So what is the journal entry after you make this allocation? Okay, the journal entry is going to be a debit, all right, to the income summary account because it had a credit balance. Excuse me, and then you're going to have a credit to each of their respective partners, $24,000 to Adams, $72,000 to Barnes. Okay, and again, where did those amounts come from? They came from here when we set up this table like this. Okay, whatever the amounts are that are indicated as allocation, those are the amounts that, and again, these capital accounts now increase, okay? On the balance sheet, the balances are going to increase by these respective amounts. Okay, and again, there will be no retained earnings. Okay. All right, everybody good? All right, so that's really the easiest situation. And again, if there's salaries, the salaries must be deducted first before any income, any remaining income is allocated. All right, and in this instance, they had enough net income. Okay, now let's make another stipulation. Remember that the partnership can also provide, all right, that basically a certain amount of interest is going to be allocated to the partners, okay, based on their amounts of cash that they invested in the partnership. Okay, so here Adams and Barnes have formed a partnership and agreed to divide any income and losses first by allocating interest at 12% of the partner's beginning capital balances. Okay, and here we're told that at the beginning of the year, okay, Adams had the balance in Adams' capital account was $160,000, and again, Barnes's capital account had a total of $40,000. And again, it makes sense, right, that if the partners are contributing vastly different amounts of different amounts of cash to the partnership, it makes sense that the one who provided more cash is going to want to get some type of additional compensation for that. Okay, and this scenario provides for that. Okay, so again, we start with the net income of $96,000. That was the balance again in the income summary account for the partnership. All right, now since so they're making this stipulation first for interest, and then they're going to distribute any remaining earnings evenly. Okay, so what are we going to do? We're going to take, for Adams, we're going to take the $12,000 times the $160,000. So the $160,000 times 12%. Okay, and all we're doing here is taking what the beginning balance was and multiplying by the agreed upon interest rate. So $160,000 times the 12% equals the $19,200. All right, so that's going to be the first allocation of net income, and that's going to go to Adams. Okay, and then Barnes is going to be compensated equally. We're going to take the $40,000 in Barnes's capital account, multiply it by the 12% that is stipulated. So the Barnes is going to get an initial allocation, okay, based on the amount of capital of $4,800. Okay, so by this, okay, by allocating for interest, okay, what happens that the 19,200 plus the 4,800 equals $24,000. $24,000 of the net income has been allocated, and what remains to be allocated is $72,000. Okay. Again, always set up your partnership net income table like this. Okay, so now we have $72,000 remaining, and the partnership agreement provided that any remaining income is going to be distributed evenly. Okay, so the $72,000, $36,000 of that is allocated to Adams' capital account, $36,000 is allocated to Barnes' capital account. Okay, now all the net income has been allocated after this point. What happens to Adam's capital account at the end of the year? It is going to be increased by $55,200. What happens to Barnes's capital account? It's going to be increased by $40,800. Okay, and again, remember, it's basically coming from the income summary account. The income summary account had a credit balance. So now at year end, we are going to debit the income summary account. Okay, and we're going to then credit the Adams capital account for $55,200 and credit Barnes's capital account for the $40,800. And again, these amounts are added to whatever they're here. Let's say they didn't take any draw, or if I told you, okay, I'll give it to you. If I told you that they were the partners basically didn't withdraw any money from the partnership, and they also didn't add any additional investments to the partnership. Okay, this is all the information that we had. What would be Adam's capital account balance at the end of the year? What would be Adam's capital account balance? What would we do? What's the starting point for Adam's? Okay, what's the balance in Adam's capital account at year end after this journal entry? Not 55,200. Remember, what was the starting point? Remember, Adams already had a balance of 160,000, right? That's how much she had contributed to the partnership. So the balance in her capital account would be the $160,000 plus the 55,200. Not minus. Remember, here we're crediting the capital accounts. Very good, Francisco. It would be the 215,200. Okay, remember, Adams already had a capital account for the balance of 160,000. Here we're increasing, since we're crediting the capital account. We're crediting the capital account for an additional 55,200. So therefore, the balance in Adams' capital account is $215,200. What's the balance in Barnes's capital account at year end? Again, so credit always. That's exactly right. Remember, because Joshua, remember that the partners' equity accounts appear on the right-hand side of the balance sheet. So remember, they typically have credit balance, just like all the other, if it were a shareholder equity account. Okay, and it's just because here it's just a partnership, but it still has to have a credit balance. So what's the balance in Barnes's capital account at year end? Very good, 80,800. Very good. We started with the $40,000, and then to that amount, that capital account is a very successful year. Okay, his capital account increased by $40,800. So on the balance sheet, if I looked, what would be the total of Barnes's capital account? It would equal $80,800. Okay, so remember that. All right, very good, Daniel, Francisco, Gerson. Okay, the partnership accounts already, the individual accounts already had balances. This is just changing. This is adding to the balances. Again, if we're crediting them, we're increasing the capital accounts. If we debited it, we know that if there was like a net loss, then we would be debiting the capital accounts. Okay. Very good. And that's a tricky question. Remember that, okay? Because the capital accounts are permanent accounts. Okay, now let's get more complicated. You know, it always has to get complicated. Now, Adams and Barnes formed a partnership, and they agreed, okay, in the agreement that first they're going to make, when they have any net at year end, regardless of whether they have net income or loss, the first thing they're going to do is allocate a salary of $12,000 to Adams, $60,000 to Barnes. Okay, so very good here. Again, let's look. Start with $96,000. Again, we're making that salary. Okay, because the salaries to the partners cannot be deducted on the income statement. Right? It's not an expense that's allowed. It must be partner salaries must be considered in the allocation of net income. So here, the $72,000, that's the first allocation of net income. All right. Then after that, they also decided that they are going to provide for 10% interest at the beginning balances, okay, in the partnership equity accounts. So at the beginning of the year, Adams had a capital account of $160,000. So how much interest is going to be allocated to Adams accounts? The $160,000 times 10%. And that equals $16,000. Okay. So here we see $16,000 of interest allocated to Adams capital account. Okay. Now Barnes, we saw, had a total balance of $40,000. Okay, in his equity accounts at the beginning of the year. The $40,000 times the 10% interest provided for, again, equals $4,000. So Barnes is going to get an additional cash net income allocation of $4,000. Okay, these two allocations here for interest equal $20,000. So now another $20,000 of net income has been allocated. Okay, how much net income remains? $4,000. And again, in the partnership agreement, they said any remaining income is going to be divided evenly. Okay, so here they have $4,000 of income. It was basically allocated 50% to Adams, 50% to Barnes, or half of the $4,000. So how much? Okay, after, and again, here the partnership agreement stipulated that this is the way income is going to be divided. If there was no partnership agreement, or the partnership agreement didn't provide as to how net income would be divided, the $96,000 would just have been divided evenly. Okay, and Joshua, can you explain the calculation? Yep, for $16,000. So what happened here? The second thing that was stipulated in the partnership agreement is that interest at 10% of each partner's beginning capital balance is going to be provided for. So 10%, what was, and here the last sentence, Adams has a beginning capital balance of $160,000. Okay, so that $160,000, his partnership, his capital account at the beginning of the year was $160,000. So 10% of interest is going to be equal $16,000. So $16,000 of net income was allocated to Adams. Okay. Here, Barnes had a beginning, you're welcome, had a beginning capital balance of $40,000. Again, they get an additional 10% of interest on their amount of the capital account. So $40,000 times 10 equals $4,000 here. Okay, now they have $4,000 in net income remaining, divided evenly. Okay, now there's no more net income. Everything has been allocated, and then how much is Adams' partnership account going to increase, capital account going to increase by? $30,000. How much is Barnes's capital account going to increase by? $66,000. Okay, so that closing journal entry, okay, when the income summary account is closed for the net income at year end, again, it's net income here that's being allocated, so that means the income summary credit balance. So to close that temporary account for the income summary, you debit that income summary account for $96,000, and then you're going to credit each of the partners' capital accounts. Adams for $30,000, Barnes for $66,000. Okay, and if I ask you after this journal entry, again, what was the balance in Adams' capital account at year end after the closing journal entry had been made? What was the balance in Adams' capital account? What would you say? Very good, Dante. $190,000. Excellent. You would take the $160,000. Remember, that was the balance that was already in the account at the beginning of the year, and then you're going to add, for Adams, you will add the additional $30,000 that was allocated. Okay, so what was the ending balance in the capital account? $190,000. Okay, very good. All right, so getting a little repetitive, you're getting comfortable with this, right? Okay, now we're going to make it a little bit more complicated, because what's happened so far, right, is that there was net income, and there was a net income to allocate each of the different stipulations for partnership allocation. Okay, so let's here now go to a little bit more complicated. All right, so now in this instance, okay, and again, remember, I'm always setting up the worksheet, the work paper the same way. Okay, so here, Adams and Barnes formed a partnership and agreed. So for this particular year, it was only $50,000 of net income. Okay, but the partnership agreement did stipulate that Adams is going to get a salary of $12,000. Barnes is going to get a salary of $60,000. Okay, but what's the problem? You could see immediately that there's not enough net income to cover the salaries. Okay, again, it doesn't matter if there's not enough net income to cover the salaries, you still must make the allocation. Okay, so look what happens here. Net income is only $50,000. Okay, but they did agree for the salaries deduction. Okay, so here what happens right off the top, Adams is still going to get an allocation of $12,000. Okay, the salary, Barnes is still going to get that allocation, $60,000. Okay, but wait a minute, that equals $72,000. Doesn't matter. Okay, each of those partners has to be provided with that salary calculation. Okay, with that salary allocation. Okay, so what's the remaining net income to be distributed? Oh, we see here already, it's a negative $22,000. Okay, doesn't matter. You still have to go on and make the second allocation, which here, again, is that 10% for the balance of the partner equity accounts at the beginning of the year. Okay, so here, Adams still gets the 10% based on the $160,000 balance in their capital account. So the $160,000 times 10% still gets that $16,000 allocation. Okay, and Barnes still gets that 10% allocation, $40,000 times the 10%. All right, these two added together equal $20,000. This is going to still increase the negative net income. Okay, so the negative $22,000 plus the negative $20,000. Now what happens? There's a negative allocation of $42,000, which still must take place. Okay, remember here, any remainder is going to be divided evenly. It's at this point, okay, that $42,000, that negative $42,000 is now going to be allocated in the percentage indicated, which is 50-50. Okay, so who eats that one half, that 20 of that $42,000? $21,000 is going to be the amount that Adams' capital account is decreased by. Okay, and the $21,000 is going to be the amount that Barnes' capital account is going to be decreased by. So what's the ending balance in Adams' capital account? Okay, well, what's the ending amount that's going to be allocated to Adams' capital account? Again, it's going to be $7,000 for this year. How much net income gets allocated to Barnes? $43,000. Okay, so here, okay, if certain stipulations have been made in the partnership agreement, again, those stipulations must be followed. So even though there's not enough net income to follow the to basically fund the salaries and the income, those allocations must still be made. Okay, and then here, how do you know you've done it correctly? Because here you see here that the total allocations to the partners equals $7,000 plus the $43,000. Those two amounts together equal the net income. Okay, and why? Because again, it wouldn't be fair just to split that net income 50-50, right? So one partner has provided more services. Okay, one partner has provided more cash. All right, so the partnership agreement must still be followed even if there is a net loss. Okay, and at the end, you can see that the amount of net income, this is the proportion it's going to be allocated in. Okay, so here we have now, again, the income summary account, the net income for this year was $50,000. It had a credit balance. Okay, so how is this allocated? How is this allocated? So here you can see how it's allocated. Again, what would be the journal entry? All right, so they didn't give us the journal entry here. What would be the journal entry then at year end? I'm just going to put it here, just spatially. Okay, what will be the journal entry at year end? Which account gets debited here? Okay, the closing journal and not Adam's account. Remember that which account, which temporary account are we going to close first, Francisco? First, the income summary account is going to be debited by the $50,000. Oops, by the $50,000. Okay, and then what's going to be credited? The partner's capital accounts will be credited. Okay, and how much would Adam's capital account be credited for? Okay, it would be credited for the $7,000 allocation. Okay, and how much would Barnes's capital account be credited for? For the remaining $43,000. Okay, and that would be the closing journal entry then here. All right, so just remember, even if there's not enough net income, all of the contract stipulations must still be provided for. All right, now what happens here? What if and this happens all the time. Okay, this is not hypothetical or theoretical. This happens all the time. When you enter into a partnership, you're going to have good years, and you would have good. So here, yes, if they would have had a net loss, excellent question, Francisco. Yes, you would debit each partner's capital account. Yes, but even if it had a net loss, and we're going to see that in the homeworks, okay? Even if you had a net loss, you would still have to make that allocation for the salaries and for the interest also. Okay, and let's see here what happens. Let's say this year was, it was a bad year. It was the first year of operations. In the first year of operations, they only had an income of $30,000. Okay, again, it doesn't matter the amount of net income. You're still, the partnership still has to make the salary allocations, $12,000 to Adams, $60,000 to Barnes. So now, right off the top, they're subtracting a $72,000 allocation. What's the balance now in the net income? The net income, negative $42,000. Okay, still doesn't matter. You still have to make that allocation for interest on the beginning capital balances. So now $16,000 plus the $4,000, you're going to increase the amount of that loss by the $20,000. Which equals how much? Which equals a negative $62,000 must be allocated. Okay, remember it's going to be allocated in this agreement. It's 50-50. So each of the partners' capital accounts gets allocated a loss of $31,000. So what's the amount at year end after all these allocations? What's the amount that is going to be allocated to Adams? Adam's capital account is actually going to decrease by $3,000. Okay. How about Barnes's capital account? If we go through all the calculations, Barnes's capital account is going to increase by $33,000. Okay. So again, and remember, all the net income has to be allocated. All right. So what would be the journal entry in this instance at year end? Okay, so now we know the first thing, we know that the income summary account has a balance of $30,000, all right? So we're going to debit that income summary account for $30,000. Do you mean decrease? Okay, so let's look here, Dante, what happens here. Okay, so we know the income summary account at year end here is $30,000 of net income. So to close that account, we're going to the income summary. But what happens to Adam's capital account here? Only Adam's capital account is going to be decreased here, right? Adam's capital account is going to be debited here, all right, for the $3,000 because it is being decreased. Yes, exactly. And what happens to Barnes's capital account? Again, Barnes's capital account, because of the stipulation that they made for dividing salaries, Barnes's capital account is then going to be credited for the $33,000. Okay. Right. And here again, all right, so what is the balance then in Adam's capital account at year end? Anybody want to try? What's the balance in Adam's capital account after this journal entry takes place? Anybody want to try? Again, always start with the opening balance, which equals what? 160,000, right? That was the amount at the beginning of the year. And then what are you going to do? Very good, Dante. You're going to subtract in this instance the $3,000. Very good. Okay, the $3,000 at year end. So what's the balance in Adam's capital account at year end? $157,000. Very good. Okay. So, and again, the key is set up your chart this way. Okay, and always remember that you still have to make the deductions for any salary and any interest, okay, even if there's a loss. Can a partner's capital account? No, it can't really drop below zero, no. What's going to have to happen is that that means the partnership is basically insolvent at that point. So what the partners, if they want to try to keep that partnership solvent, they're going to have to make additional capital contributions. Okay, good question. All right, so everybody's good with this? That is it. Okay, so that is it for this chapter. Now we're going to go over the homework for this chapter. All right, and now just so you have a little bit of a heads up, this was pretty much an easier chapter. Again, it was different from anything that we've learned because we've always been dealing with partnerships in the past. I'm sorry, with corporations in the past. Not to scare you, okay, but please, when we meet on Thursday, please make sure that you read the next chapter beforehand. Okay, the next chapter that we're going to talk about is finally, you're going to learn about the statement of cash flows. Okay, the statement of cash flows, that's the chapter we're going to have a quiz on, okay, in the next, let's say, 3 weeks. Okay, the statement of cash flows is a chapter that you're going to be, that you're basically going to unlearn any gap theories that you've learned, okay? For the statement of cash flows, you're going to have to basically unaccrue any revenues, and you're basically going to have to unaccrue any expenses. Okay, the statement of cash flows deals with cash only. It's a very different chapter. It's a complicated chapter. Okay, but there are certain formulas. So please, by next Thursday, I want you to read that chapter. Casey, yes, absolutely. I'll post this on Blackboard after the fact. The homework, absolutely. Okay. Thank you for the reminder. All right, so let's again, please make sure you understand, you read the next chapter beforehand. So let's go now to the homeworks. Again, they start easy, okay, but again, these could be theory questions as well on the exam. Okay, so the first is for problem C1. Okay. So here, easy manufacturing, it has a partnership, and there's 3 individuals in the partnership, okay? The partnership contract states that the profits will be split evenly among the 3 partners. So again, that's 33 1/3, 33 1/3, 33 1/3 at year end. During the year, Gonzalez withdrew $25,000, Todd withdrew $23,000, and Walker withdrew $95,000. Okay, and at the beginning of the year, at the end of the year, the amount of net income to be distributed equals $180,000. Okay, so here, and again, they're just setting up this problem a little differently. Here, they're starting out with whatever the beginning balances were at the beginning of the year. Okay, so A, calculate the amount of each partner's share of net income. Okay, so here, basically, you're told it's going to be divided evenly. So the $180,000 divided 3, okay, equals $60,000. So the amount of net income allocated to each partner is going to equal $60,000. Okay, so that's pretty straightforward. Describe the effect. Okay, so this is really important. Okay, so everybody here, because this is always a question on midterms, finals, and the CPA. Okay, describe the effects, if any, that partnership operations, describe the effects, if any, that partnership operations would have on the individual tax returns. Okay, so remember, the amount of net income allocated to each partner, the $60,000, that is the amount that the partner must claim, okay, as income on their tax return. Again, it doesn't get affected by the amount of additional cash contributions or by the amount of withdrawals of cash. If each of these partners didn't take a penny out of the partnership, okay, that is, they withdrew nothing, they would still have to include the $60,000 on their tax return. Okay, and then letter C asks us prepare a statement of partnership equity. Okay, and here assume the beginning partners' equity balances were $50,000, $60,000, and $40,000. Okay, so again, go with what you know. You know that 2 of those capital account balances, each partner was allocated an additional $60,000. Okay, now that means now you have the subtotals for each of the partners' capital accounts in this particular line. Okay, but remember the partners, again, withdrew money. So for the amount of cash that was withdrawn, those withdrawals are going to decrease the amount of the capital accounts by $25,000, $23,000, and $35,000. Okay, a total withdrawals equaled $83,000. So what are the ending balances in the capital accounts? $85,000 for Gonzalez, $97,000 for Todd, and $65,000 for Walker. Okay, but remember the amount of net income that is going to be taxable to each is $60,000. Okay, it's just that these are the balances that are going to appear on the partnership balance sheet. Okay. All right, so there we have that. So let's then go to the second problem, which is for the comedy club. Again, this comedy club is going to give us certain different examples. All right, and at the end of this, you will be an expert on the allocation or distribution of net income. All right, so here, C10, there's a comedy club that was organized as a partnership with Abbott investing $80,000. Okay, and Martin invested $120,000. So during the first year of operations, the net income amounted to $110,000. All right, so here we're always starting with the net income. Okay, so here, let's keep it easy for A. Determine how the $110,000 of net income would be allocated, okay, based on 3 different scenarios. Okay, so the first scenario here is that all the income is divided 35% to Abbott, 65% to Martin. Okay, so here all you would do, start with the $110,000. $110,000 times 35% equals $38,500, which is the amount that's going to be added to Abbott's capital account. Okay, and Abbott's capital account is going to increase by $38,500, and then the $65,000, okay, times the $110,000 of net income. Okay, that is going to equal $71,500. that is the amount that is going to be added to Martin's capital account. Okay, so what is the ending balance in the capital accounts? What is added to the capital accounts of the partners? 38,005 is going to be added to Appett's account. 71,005 is added to Martin's capital account. And remember, all the net income now has been distributed. There's no retained earnings. Okay. All right, that was simple enough. Again, even if it's a simple problem, always set it up this way so that you don't make a mistake. Okay, and again, if I asked you what was the amount in Abbott's capital account at the end of the year, all right, you would start with Adam's capital account at the beginning of the year. Again, does it tell us Adam's capital account had? Oh, they didn't tell us here, so it's fine. So, but that's the amount that it would increase by. Okay. All right. So now let's go to number 2. In number 2, interest is going up 15% is going to be added to each of the beginning capital balances. All right. So here again, we have the $110,000. However, there was a stipulation as to allocation of interest. So again, the beginning capital balance of Abbott was $80,000 in this situation. $80,000 times the 15% means that Abbott is going to be allocated an additional $12,000 net income. All right, and Martin, based on their $120,000 beginning capital balance times the 15%, okay, is allocated an additional $18,000. So based on that $110,000, now after this, after the interest has been considered, $130,000 of net income is going to be deducted. What's the remaining amount? The remaining amount of net income is $80,000. How is it allocated to the two partners? Again, 50-50. Okay, so out of that 80,000, Abbott is credited for 40,000. Martin is, I'm sorry, for 50%, which is 40,000. And Martin is credited for 50%, again, 40,000. So then that means, so the capital accounts have been fully allocated. How much is Abbott's capital account increased by? Abbott's capital account then is going to be increased by $52,000, okay, at the end of this year. And Martin's capital account is going to be increased by $58,000. Okay, and all net income has been distributed. All right. Do you feel comfortable with this? Going to become experts on allocations of net income. All right. So now we're going to take the third and the last scenario. Okay. In this situation, what happens is okay, salaries of $36,000 are going to be allocated to Abbott, and salaries of $56,000 are allocated to, and again, these are 3 different situations, okay, based on whatever is provided in the partnership agreement. This is how the income is going to be allocated. So $110,000 is a net income. First allocation is for salaries. So add those 2 together. $92,000 now of net income has been allocated. Okay, so now what's the remaining net income after the salary allocation? That equals $18,000. Again, how is any remaining net income going to be allocated? It's going to be allocated the first allocation, again, then they're going to allocate for interest. Okay, so the beginning capital balance of $80,000 times 15% equals $12,000. So that's an additional allocation to Abbott. And then Martin is going to get 15% on their beginning capital balance of $120,000, which adds to, what was that? Which adds to their allocation of by $18,000. Okay, so 100, now again, since the second allocation of interest, 12,000 plus 18,000 equals 30,000. Again, that's going to be deducted. But wait a minute, we only have $18,000 of net income to be allocated. Doesn't matter. The full interest allocation still has to be made. Okay, so $18,000 positive net income reduced by the $30,000 interest allocation for me results in a negative $12,000 of net income. Okay, and again, that's the residual net income. That was decided it was going to be always divided 50-50. So here, what is the amount that is going to be allocated to Abbott's account based on this residual income? Negative $6,000. So the capital account is going to be decreased by $6,000. Okay, and then Martin's capital account is also going to be decreased by $6,000. We're dividing this $12,000 evenly. Okay, now at the end of this, all net income has been allocated, and these are the amounts that the capital accounts are going to increase by, okay, for this particular year. Okay, again, all based on the partnership agreement. Okay, and then letter B here, prepare the journal entry to close the income summary account using the division of net income developed in C. Okay, and number 3. Okay, so here we see the net income is going to be basically allocated to Abbott, $42,000 of that net income, and $68,000 of net income is going to be allocated to Martin. Okay, so what is that journal entry going to be? Again, we know that there was there was income. Oh, sorry, this didn't actually come out clearly here. So the income summary account had a credit balance, we know here, of $110,000. Right. So to close that income summary account, we're going to debit it $110,000. Okay, and then we know that here Abbott's capital account is going to be credited for the $42,000. All right, and we also know here that Martin's capital account is going to be credited, thereby increasing it by the $68,000. Okay. And that is it pretty much for partnerships. All right. Again, this is like a standalone chapter, but very important to know. All right. So if there are no questions, what time is it? 11:20. Let me see. You know what I'm going to do? I'm going to end class a little early today because I want you all to now, I know I was going to say run home, but you can't run home because you are home. But I want you to all take this time, this couple of minutes that are remaining, and start reading the next chapter. I think it's chapter 13. It's that pivotal a chapter. Okay, just to give you a minute of overview. All right, we are going to be talking about, okay, and it's very important, we are going to be talking about the statement of cash flows. This is the financial statement, again, that we have never discussed so far in your accounting studies. What is the big difference with the statement, the statement of cash flows? The difference with the statement of cash flows is it's the only financial statement that is prepared on a cash basis. Okay, the only financial statement. So what happens when you're preparing the statement of cash flows? You basically have to unaccrue all of the accounts. Okay, so imagine this. You have to unaccrue all the accounts that appear on the income summary, okay, and the related balance sheet accounts. Balance sheet accounts. Okay, so it is a killer of a financial statement. Again, it is a required financial statement. Okay, meaning that GAAP requires that this financial statement be prepared. All right, and I'll just give you a little bit of an overview just so you understand what is going to happen. All right, there are basically three different sections on the statement of cash flows. Three different sections. Okay, the way that I want you to remember it, and again, it sounds unusual. It's basically the first section, and it must be reported in this order. Okay, the first section of the statement of cash flows is basically the operations, results of operations. Okay, the second section of the statement of cash flows is the investing section. Okay, and the third section of the statement of cash flows is the financing section. Okay, so you have these three different sections that must appear on every statement of cash flows. Okay, what's going to, and the way I always remember, I always tell my class, you know, like, okay, that's unusual. But when you think of the statement of cash flows, I just want you to immediately think the best way to remember it is OIF, O-I-F. Okay, a little mnemonic just to remember it, O-I-F or OIF, whenever you think of the statement of cash flows. Okay, within each and every one of those sections, what you're going to have is basically all of the cash. You're going to have basically a summary. Change color here. You're going to have a summary of all the cash inflows. Okay, because remember, it's on a cash basis. You're going to have a summary of all the cash inflows and all of the cash outflows that pertain to that. Okay, so you have the cash inflows and the cash outflows for the operations section. You have cash inflows and cash outflows for the investing section. All right, and then you're going to have the cash inflows and the cash outflows for the financing section as well. Okay, so after you have all of the totals in these three sections, okay, the amount of cash inflows and the cash outflows, if you add together all of these changes, what it's going to tell you at the end was what the change in cash was, okay? It's going to tell you what the change in cash was over this year. Okay, so here you have what and so it was cash inflows minus cash outflows. Okay, so it's cash inflows minus the cash outflows in each of these three sections. Okay, then you're going to come out with the subtotals for each of these three sections, X, Y, and Z. So when you add together the subtotals for these three sections, it's going to tell you what the change in cash was over this year. Okay, okay, and remember all the financial statements are interrelated. If you take what the change in cash was, okay, you take it here, plus you add to that what the beginning cash balance was, okay, on the balance sheet, the beginning cash balance, okay. So if you take the beginning, if you take what the change in cash was over this year, you add the beginning cash balance as of the balance sheet. Okay, what are you going to get? You're going to then arrive at your ending cash balance on the balance sheet. Okay, so that's how you could tell if your statement of cash flows is correct. Okay. You're going to take what the change in cash is over the year. You're going to add what the beginning cash balance was on the balance sheet, plus the changes, and that's going to, it should tie into what your ending cash balance is on the balance sheet as well. Okay. All right, so I hope I whet your appetite as to what the statement of cash flows has. I'll leave you now at this point. I'm going to post the homework for Appendix C on Blackboard. All right, and please read the chapter. It will make your life easier because it is such a different, important chapter. Okay, so everybody have a good day. Stay healthy. Okay, register to vote if you haven't already, or vote early, whatever you can possibly do. And I'll see you on Thursday. Okay, have a good day.